Kison, how are you, my friend?
I am doing great, Ryan. How you been?
I'm so excited to have this conversation. You have had quite the journey over the last few years, as well as I have. And it was just doing a little bit of a catch up. And our dear friend Dan Golden, who introduced us, actually called me this morning. So, must be the signs from above that this conversation was meant to happen. So, I appreciate you taking the time, my friend.
Hey, my pleasure. Looking forward to the convo.
So let's give the listeners just a quick snapshot of your background and the companies and kind of the where you have your tentacles out from the different setup that you have right now, Keysign, and then we'll talk about kind of the topic at hand, which I know has been a personal passion of yours for a long time, and you've been seeing the growth that shows that the market's starting to care and listen, which is why I'm excited.
Sure. So, in short, I spent 10 years as an M&A advisor. Wanted to do something tech. Did a startup that failed miserably, but walked away from the experience of working with software engineers and how they utilize project management tools to manage building software. Figure why not a project management tool for M&A? Led to the inspiration to start Deal Room in 2012. And in that journey, made a bunch of more founder mistakes, but around started getting traction around 3 or 4 years in 2017, a good friend of mine in marketing came to me and said, "Hey, man, you should do a podcast." And I said, "What the hell's a podcast?" And he said, "Don't worry about it. It's gonna be the next biggest thing. You just got to do it." And that led to our podcast that we host called M&A Science. 2018, we spun off a virtual data room product out of our deal room suite because that continued to expand to be a lifecycle management platform. Then 2020, we started the M&A Science Academy. So we have an online platform to learn, very geared towards corporate M&A. So a lot around doing diligence, integration, and so forth. And then just continue looking to build a business line right now around on-demand M&A talent. So
Mm.
shifting M&A Science to be a portfolio of products that cater to mergers and acquisitions throughout the life cycle.
It's awesome, man. And no small project to tackle, right? The inefficiencies of mergers and acquisitions in the US, right?
I think it's an exciting space just because it is so inefficient. Not much has changed in the last 20 years.
Well, let's talk about what that, what your passion is. And then actually, before we do, like, I think for the listeners and why I found Keysign and what you're doing so intriguing, and which is why I referenced you in the Intentional Growth Academy when I was explaining the process of actually taking a company to market. I'm always talking about, like, here's how it's supposed to be done. And when I say supposed to, like, you get to the bigger size deals that you've been working with most of your life, there's a pretty regimented structure of like taking a company to market, how they're assessing it. They got investment thesis, all that kind of stuff. So it's like, hey, like here's what's possible for the lower market if they have the right resources. But you specifically picked out an inefficiency of even the bigger size deals in the corporate M&A. And actually, I just did a podcast recently, Keith, on corporate divestiture. So I've kind of been hammering through like, hey, what does the bigger companies do? But you specifically honed in on integration. And why was that?
Boy, I think it started working on a variety of deals originally with the sell side. We started working with corporates, doing IPOs, acquisitions. I learned integration from talking to practitioners and became very intrigued, one, by the complexity. This isn't the easiest part of the deal. It's probably the more complex part of doing an M&A deal. A lot that can go wrong, but essentially it's the stage that either makes or breaks. You either create value or destroy value. You hit your goals, achieve your investment thesis, you miss the mark and may have to make some write downs. That's where it made it interesting. And it's just an area that's not very mature if we think about standardization, best practices, or science. Like there's not a lot of proven methodologies behind how you integrate companies. So that's what it looked like, a great opportunity to focus on learnings and document different practices in that area.
I interviewed his mind is space me right now. I'll put it in the show notes. A gentleman that was a corporate M&A. He was in the division of a bigger corporate company that was doing acquisitions, and he'd find out that they're doing an acquisition because the board would be like, "Hey, we're buying this company," and he was like one of the executives. So then he was kind of alluding to your whole like shtick of it, like which is like I'm supposed to like get all the goals done once I figure out that we're going to be buying this thing. And then there's the deal structure. And then there's the, hey, by the way, you have to make this actually worth it. So like break down, like, what does integration mean to you? And what does a successful integration look like from an outcome perspective?
Yeah, the integration is really the activities you need to achieve the value you're looking to extract out of your acquisition, right? Because when you're buying a business, you have some intended value for it that could be is based on the strategy. Are we buying a technology to add capabilities to our offering? Are we buying a base of customer? Are we buying engineering talent? There is a clear driver of why you bought that company, and to be able to capture and deliver that value. That's what integration is to me.
Yeah, and making it work, right? Making the companies still operate as well versus like, I think about the timelines of some of the private equity firms, which can be a hindrance of successfully or wanting to even successfully integrate companies. So, I mean, when I think about like even my partners, Kisan, so they did, so Matt and Joel are my partners, and Matt, when they sold their ESOP to this PE firm, they rolled up, I think it was 18 companies in 20 months or something like that. And so they went from like 300 employees to 1,300. And I just like, hey, now, like, let's say the math of that all worked out perfect. You still have 18 HR systems, 18 cultures, 18 ERP systems, 18 CRMs, comp plans, marketing material. Like, that's just a lot of work. like, so like, how have you seen, like, from all your experience, like, how does someone normally tackle it? Like, let's talk about like what you normally sell, which was why this became your passion. Then you and I were talking about as we hit record, like what does the ultimate end goal look like and how that's incorporated up front instead, or should be, I should say.
This is where we got to define synergies because a lot of this is based on what synergies you intend on capturing. And it's fundamentally broken down into two types: cost synergies, revenue synergies. Cost synergies tend to be easier, straightforward. We're cutting costs. We don't need two CFOs. A lot of these back end roles, call centers could be consolidated into one. We're going to eliminate costs. We don't need two subscriptions for our sales force and things of that sort. Um, Revenue synergies, on the other hand, is when we're really trying to make 1 + 1 = 3.
Mm-hmm.
Can we get our sales teams to cross sell products and achieve additional revenue? Can we bring this product into our distribution channels and increase revenues? Easier said than done. So that
right. Everybody listening is going, yep, agreed. because even if they're trying to roll out their own system for their own company with their own culture that they control, it's still difficult. Right. So, how is it like? I mean, I read the stat, not read the stat. I heard it stat. Ken Sanguinario, who's the creator of the Value Opportunity Profile, talking about like how to actually take company specific risk in the weighted average cost of capital and calculate that. And so, I mean, my point is, he's very intrigued with the operational tie to valuations. But he was saying that like, is it like 80 or 90%, he said, of deals don't actually get the return that they intended. And actually, the deal was more expensive than their cost of capital. I don't know if you have any stats over there, or if you just anecdotally
it
agree.
is. I think there's a very definition on what M&A failure rate is, but I would bottom line say it ends up taking a lot longer than you anticipate. You'll get those results. It just typically ends up taking a lot longer. We tend to be very uh, optimistic when we put together these financial models, and a lot of times you have to be if you really want to sell it, if you want to get the financing in place, if you want to get the board
Hmm.
on board, you got to be very optimistic about it to get that deal across the finish line. Then the poor integration folks have to execute and try their best to deliver on that promise. And that's where it gets challenging. And that's where you don't completely fail unless something really disastrously goes wrong, where you really screw things up. A bunch of people leave the company, and then you got some bigger issues. But
Hmm.
if you do things, you tend to get there. It just takes longer than expected.
So let's talk about like if you can kind of give us a compare and contrast. So like what you normally see from like maybe a leadership. So like when you and I were talking about like the end state, like what what is the experience? And I'm trying to think about like maybe you got some stories of like what is happening afterwards. So the deal close. So like what normally happens, and why do you want to change it? And then how would the current state, or like how would you make it better if it was done optimally?
Yeah, let's walk through the ideal. So current state, let's say current state is You don't know better. You get excited about getting an opportunity to sell your business for a large sum of money. And with that, you're sort of reactive to the process and are trying to deliver the information for the buyer. And you get all the way through, and then the surprises unwind because there's a lot of things that you didn't expect. So now if we were to look at this future state of how we want to do M&A, first and foremost, let's start off by bringing that end state, what a combined organization is going to look like, to the very front end of the process to crystallize it between executive leader to executive leader. So we're on the same page.
Mhm,
Why are we looking to do this deal? What ultimately are we looking to achieve? And what is that combined company going to look like? I think
mhm,
getting a sense of that early, it aligns second to understanding each company's values, because we often use common corporate keywords to define values, but they do have different meanings for each company. And having a conversation around it allows you to understand what exactly is the culture, how's it the way of working defined with each organization,
mhm,
and more specifically, the leadership styles.
mhm,
Sometimes you find some red flags pretty early that, hey, you guys are very old school, top bottom. We're very bottoms up.
mhm,
I don't know how these companies are really going to combine or find that way of working, or maybe there's a specific way around it, or even some of the considerations you'll have down the road and how you integrate the company.
mhm,
You may get a sense of understanding the cultures and what your approach would be there as well. I think third part goes to the go to market. Can we get aligned on an outline of what that combined go to market is going to look like? What's it going to look like for that customer?
mhm,
Because currently, our organizations have their own way, respected way of delivering value to the customer. But once our organizations combine, what is that going to look like to the customer? And that's when
mhm,
you start building that outline of a go to market. I think fourth, when you go through your diligence, you will want to take that outline and let it shape over into a integration planning uh, work stream that runs in parallel to the diligence work stream.
mhm,
And this way you can actively iterate on that integration plan as you're doing diligence, because there's a lot of things you uncover in diligence that starts getting you thinking about how you're going to integrate the company. As you learn more and
yep,
more about that business, you should be able to update that plan and reference that information you uncovered in diligence. You don't have to go scramble around to figure it out.
mm,
Ideally, you want to keep the same team members intact that were participating in diligence to help manage the actual integration of
mhm.
that company.
Can you give us an example, Keyshawn, of something that you would find or like as data is getting brought to the surface through diligence that might iterate or change the integration plan?
Let's just some basic example. You're doing diligence in a company, find out they're on a totally different HR system, and that neither side has expertise in how to migrate that information into a combined system. So then that might be something where, hey, in our integration plan, we need to find a resource that can actually help with this integration, because we don't want to have two different payrolls. We want to combine them as soon as possible.
Mhm,
Let's figure that out. And you start building that into your outline and then you may define it as well as you can. There's a lot of these activities that you 100% want to have clearly defined for day one. So it's a big exercise. And the more detailed and well planned you are for integration, go in and usually stage it out, right? Here's what I'm doing day one,
mhm.
the first 30 days, second set of 30 days, the third.
How many people
And
do that?
it varies. It really varies company to company. I can tell you there's a big cultural shift in M&A where there's a more bigger emphasis on the preparation from that buy side of doing integration much earlier during diligence. In fact, you're seeing buyers push to have more control of that process so that they can do better integration planning. You see it sometimes the banker may be involved and you don't get to you have a controlled approach to
Mhm.
doing diligence when if you have both entities collaborating together, you're able to actually work and build a plan that's aligned between both buyers and sellers.
How much of this is related, Keyshawn, of like the desire to get more into the operational with like the amount of dry powder and the amount of M&A activity that's been going out there and the people that are desiring for acquisition through, to grow through acquisition, that they that they're going downstream, so, like, there's not enough cash flow to just hire the EYs and KPMGs to fix shit? Like, is it like, "Hey, like, this kinda matters matters because there's not enough cash flow for consultants to throw at it?" Or is it just more of just the M&A marketplace maturing in general, do you think?
I think a bigger fundamental difference is whether you're buying a deal from a bank process or a proprietary deal.
Can you
Because
describe for the
there's
proprietary deal for the audience?
a bank deal is usually held in an auction process. You have an investment bank, they fill out a profile, marketing materials for a company, they invite a variety of different buyers, and then they'll compete. They'll stage it out, and they get pretty limited access to information because they want to keep it competitive. And you're just entertaining a lot of different buyers, so it's hard to
Mhm,
create that bandwidth to create different meetings
mhm.
and so forth for every person to meet with a management team. A proprietary deal, you go and hunt for your own opportunity. This is what we call control your destiny, because you define a strategy. If you're an organization and you've decided that M&A is a tool that you can use against your strategy for growth, then you should have that clearly defined. Like, these would be the type of companies that would fit for the strategy that we have in play. And then you proactively go out and you find those companies, and you have this story to sell of how the target company and your organization combined is going to create a lot of significant value, be more competitive in the marketplace, deliver more value to the customers.
Mhm,
um, and then on those deals, you're working in a very mutual way with that company. You usually have more time because some of these deals happen in a much longer time frame than an auction process. You may be nurturing a relationship for a good year before the person's ready to transact,
mhm,
and you have that relationship established. I think you're more accommodating with timelines and goals.
mhm,
You have a lot more time to think things through. Some of these integration activities we're talking about,
mhm.
you definitely got a lot more bandwidth to be able to plan those things. So I think there's a huge difference. The proprietary deals tend to go a lot smoother when you have that relationship in place, controls over your timelines, as opposed to no relationship and compressed timelines.
100% agree with you, man, and I think it also I'm curious on your thoughts of it depends on what seat you're sitting in, whether you're in the seller's seat or the buyer's seat, right? Because if you and I both if I want to sell Arcona, I know I'm gonna hire an investment banker, pin a bunch of people against each other, and this is the hold, pull, and push and pull of buyers and sellers in M&A. We're like deal structure, like right off the bat, seller wants a stock sale, wants to have a hire an investment banker, pin a bunch of people against each other, all cash up closing. I mean, if you think about then the opposite side, so there's this massive canyon of like the value that's going to be exchanged, but then the operational integration. Because I think I mean, if I were to say from my perspective, obviously having that thought through collaborative approach on diligence that then mirrors the integration plan will then probably reflect the deal structure. Do you have any experience or thoughts of like, how do you get the transparency that you want without putting a buyer or seller in jeopardy of being too cozy and getting screwed over in the spirit of trying to make something work?
If you're the buyer,
Either side, actually. Yeah, like if you because I guess maybe let me rephrase it, Kisan, is like from both sides because the whole goal is to get a deal done that's right for everybody. Like that would be the ideal situation, right? So then you're trying to get the transparency, you're trying to get the upfront. You know, if you're selling, you might not want the proprietary deal because you want more competition. You see what I'm saying? Like you trying to bridge that chasm while also trying to get the deal done. So there's like a certain amount of information that you should be sharing, or to accomplish what you're trying to describe, right? Which is because I'm thinking about if I'm going to be selling my business, like on my old experience, is like here's how it all works. Well, if the deal doesn't get done, and this is a competitor that's right down the road, I'm screwed. You know what I
right?
mean? So like it's just this balance of like the goal is to get a good deal done and have everybody be happy, but like do you see is my question or comment making sense?
Yeah, I agree. I mean, in the deals I've worked on, it's always the lack of information that causes the issue. So
Yeah,
I would
fair
be
enough.
more proactive to ask the tough questions to get a good understanding. Even as a company today, we get approached by potential buyers, and there's just a lot. I'm always curious on what their investment thesis is. Like, how do you think you're going to build this out and create more value than we're doing? Because
I love it.
that's all. If you can really do a better job than we're doing here, I'm open to it. Let's talk about it.
That's a wonderful point.
But so even on that side, but on the buy side as well, because you want to understand what are the goals, even of that management team, do they want to stick around? And I think when you think about the exit, you're right. Because as a seller, you can say, hey, I want to create a competitive environment, get the highest price. But if I can come to you, even though I'm reaching out, but this is an opportunity that I see strongly aligns with our strategy, then I'm really confident that there is an opportunity here to create an immense amount of value as combined companies together,
Hmm.
and that I'm going to compensate you fairly. Like I'm not coming here trying to get a deal, a sweetheart deal in this market. Now I understand you got options, but I just see that we would be a great fit because of
Hmm.
these areas that we can see that we can create value. And I'm comfortable to build a model out and be transparent and share that with you and how we're thinking about what your company's worth, and how we pay for it. And also, what kind of flexibility and terms you have, because that's all your approach in negotiating with it.
Hmm.
Maybe that person is there, they want to be participating in the next series of growth for the organization. Well, can you build that kind of retention around it? And a lot of times you can make some very favorable retention plans that are just as good as having that level of ownership,
Hmm.
and allows that person to continue to reap the fruits of the carried forward growth.
Well said. Yeah, and it's just like the hand glove, right? You're just trying to be a lot more thoughtful to make sure that it's the right fit. And one of the things that you'd mentioned when you were talking about the different points was the go-to-market strategy. Um, I think that's a very interesting call out because I have more interviews than I can count, Kisan, of like that's where the egos and the conflict really start to show their head because of difference of opinions and how that trickles through the entire organization. Can you walk us through like where you've seen success or failure based on the lack of discussion around that?
I think the key is having that discussion early. The biggest friction I've seen is you get to close and you haven't really thought through what go to market's going to look like. That's a big problem. And then you have big discrepancies around it, or realize there's a lot of questions to answer. There's a lot of questions in what are their customer base, what their profiles are, what percentage overlap do we have? Then it just, those things are big ticket items that dictate how you're going to approach integrating the go to market.
Yeah.
Then you got the whole operational piece underpinning it in terms of what the systems and those things, which get even more complex.
Well, I think agreed, man. And what I see is people focus on that, the cost synergies and the operational things, because it's easy. Like, okay, we have a specialist in this HR system, and they have one in this one, and we're obviously the mothership. So, and I mean, obviously, that's an easy, straightforward answer versus a thought through one. But the revenue synergies, man, it's so funny when I think about like the couple of stories that I've got top of mind is like this Bobby Martin that I interviewed. They hired him, they bought his company saying for all the synergies, and then they got his data, and then they gave his sales reps a comp plan that there was no way he could accomplish his earnout. Like it was like, wait a second, of course I could hit my plan, but now they've got 20 more products and services my sales rep have to sell. And that was not discussed. Or like I have a client where they sold and they were revolutionizing their industry, and then the person that they sold to, it was like I mean, I know this is so cliche because Kisan, but like it's like solution based selling versus transactional product. And the solutions based selling company sold to the mothership that does the transactional selling. And the whole team realized in the first kickoff call, like, oh no, we sold to the wrong philosophy. Why do you laugh like that? Because it's like,
Because it's true. I watched our team transition because we used to sell on the lower end of the market in a very transactional sale. Now we sell very much of an enterprise solution selling approach. So
like
it's
I know, man. It's hard, and so let's talk about how the integration could play out as it relates to kind of like how the deal structured that are potentially out there. Like, so like I'm trying to think about like how many people go straight into trying to just structure the deal, but then don't think about the integration that correlates to that. So like, what are some things to be thinking about as people are thinking about integration, whether they're going to be staying or not staying? Like, how does their decision making during that transaction impact their role and what they're planning on doing and how they could structure the deal?
I think you said it in that right there, decision making. That's like the biggest fundamental key in how to make integration work well. Because if you look at what integration is, it's a lot of change that happens, but there's a lot of decisions behind those changes that need to happen at a fast pace. So when you look at a lot of organizations, they tend to have a varying culture around how they make decisions.
Mm,
So I think that's a key thing to
interesting
identify
aspect.
with first and foremost and define and almost clarify what that framework's going to look like when approaching
Mm.
integration. What's the decision making framework? Who's going to be, what's the, what's the, how are we going to keep up with this demand to make a high volume of decisions in a short period of time?
If you're enjoying this conversation about integration and how to make an acquisition actually worth it, whether you're the buyer or the seller, by the way, this is all about aligning expectations with reality. And if we take and reverse engineer what the ultimate end goal of two combined companies looks like, we have to bring that forward into the due diligence process that is part of due diligence and the acquisition and transaction. So that way people can start executing right afterwards. The first place to start is the Intentional Growth Academy because it walks you through valuations, deal structures, but then also in principle number 4, how do the 8 functional areas of a business that are essentially part of the due diligence and how the operations are correlated to the risk of the future cash flow. So my favorite example of the acquisitions done well is when two people understand how the companies that are getting combined are going to result in the 8 functional areas tied to the valuation, tied to the risk of that future cash flow, which impacts the future multiple. Go check out the Intentional Growth Academy. In the link in the show notes, we offer $500 off. So it's only $995. So $1,000 for the do-it-yourself. If you're not ready for that, go check out the Intentional Growth Financial Scorecard, which gives you a score based on how well you're running the company as a financial asset. And it comes with 5 videos that are a case study pulled from the academy, gives you a little bit of a flavor of how well you're doing as well as the value that's in the academy. I know that both these resources are worth checking out because I was at a breakout last week in a conference and one guy looked across from me and said, if I would have known this and we were dealing with a normalized EBITDA exercise as well as an integration checklist, he said it would have saved him 15 million bucks. Anecdotal, and I know he could have been making that up, but for what it's worth, I know that the people, once they've gone through it and they've already been through a deal, they actually understand the value of this material and this knowledge. So at least go check out the scorecard, if not the academy. Thanks for tuning in, and we'll keep rolling into the episode. Let's talk about, because that kind of insert what you've been doing for so long now. Like, how do you accomplish that? Because maybe talk about the space that you've been working on tackling. Kison, of like the deal room, project management, integration. Talk about how your guys' systems work to actually do that, because it's fascinating. What was it like before, and why did you start tackling with a software product? Maybe reference your old days and why you decided to get into tech.
Yeah, it's evolved. I think in the early days, we thought there's got to be something better than Excel, and that was the first thing. Usually, when you see things done in Excel, it's a indicator there's a highly inefficient, and there's a lot of inefficiencies, and things could be done much better. That was early. Just hey, can we build a project management tool, make M&A more efficient? I think if you fast forward today, we have a huge emphasis around best practices. We have a whole framework called Agile M&A, which is inspired by the same
Mhm.
Agile software engineers use to be iterative and respond to changes as they happen. A lot of commonalities with the way you do M&A because you start off with a little bit of information and you get more information. And information either leads to identifying risks or identifying opportunity. How quickly can you respond to it? And that by nature is where we've been defining a lot of the practice, and they go hand in hand.
Mhm.
Because once you adopt the practice, then can you build a tool around it to help standardize those practices? So that's where we have Agile M&A and then Deal Room. They work well when they're both in play.
Mhm.
I think Agile M&A helps get that culture or fosters that culture of being change oriented. Once you have that established, there's essentially this culture that comes along with it of continuous improvement. Then you can introduce all kinds of tools and
Mhm.
other things there. So the practice should come first. The tools there to help standardize those practices and get the most out of it.
And I can't remember. It's been years since you and I were chatting about some of the stuff that you're working on, but like, and you're adding information to the process, right? Because like information knowledge, like access to the information to make the decisions. So like how often first of all, is that correct? Do you have like a due diligence library tied into the project management system, right?
Correct. A lot of it's centralizing information in one place
Right.
and being able to repurpose it, right? Because if you do integration as a whole different work stream that's completely separate, a lot of this you get a knowledge chasm. And the better you can connect your diligence integration process together, you're going to get a lot more retention on that knowledge. You're going to be able to have better planned integration, execute faster, ultimately execute better, and have better outcomes.
And with the how many of the people or the companies that you're exposed to have an ongoing due diligence record keeping library on purpose, regardless of whether they're trying to sell? Because I think that this topic becomes just like the nightmare of everybody, where it's always reactive versus like keeping up on that stuff. So like not only could they acquire, but then sell should or have a conversation about selling as fast as possible. I mean, what's the maybe breakdown of how many people manage their corporate information like that?
It's a good question. I think it's a big variance there. You may see larger public companies have a structure in play. I've seen it. Larger company goes through an IPO, for example. You organize your data
Hmm.
in a very intensive, disciplined way when you do that. And if you keep that intact, you could repurpose it quite easily for additional fundraising or any other purpose. Um, when you look at smaller companies, they don't usually do that at all.
I know. I remember. I mean, the amount of times in our academy where I'm like, "Hey, so due diligence," and people are like, "Oh my god!" It's just like people's worst nightmare. So, but it's like I was trying to explain. I'm like, you're trying to recreate the whole story of your company. You're back, going back to all your financials and all your records and trying to prove your story in real time, and how damn stressful that is.
That's the song that doesn't get old is how you're prepped for diligence. And it's so true. It's so true. When you look at a deal and their stuff is beautifully organized, you get excited about it. You're like, this company has their shit together.
Right.
I'm already comfortable doing this deal. It's just like walking in the house. I think we were talking about house hunting
Yeah,
earlier.
right, right.
I mean, I saw it. The house was just everything's done. I mean, this place has no work to do, and I'm paying a premium for it. At
On
the end of the
purpose for a
day,
reason,
and
right?
it's yeah, I'm just like, I don't have work to do. I don't care. I'm paying in this market right now 20% more than I want to, but there's no question about it. It's just, it's everything's immaculately done. They've obviously done the work. They've taken care of it. It's even less diligence for me to do. I'm already convinced. I
Mm.
think selling the company, it's the exact same way. So
Oh,
the better.
geez, that is so awesome, man. I have in our training, I have two pictures of a house, the same house, but one's a total pile of shit and the other one's walking ready. And I'm like, this I just related to the business. I'm like, it's twice the value of the other one. It's the same damn house. Just different types of buyers. And I think, a while back I interviewed David Horsager about trust and how trust is just I mean, that's what we're exchanging back and forth. And like what you're doing is you're enhancing the trust, therefore protecting the price or the reason to buy on both sides.
I agree. One thing I just thought of that we didn't touch on, I was thinking the other area to make the deal successful is the reverse diligence.
Mm,
And I think this is a concept that doesn't get talked about too much, but if you're buying a company, how much time do you spend to help them understand your company, what your different business lines are, where are they going to fit into it, and essentially help them do diligence on your organization. But that's something I think is a really good exercise that helps make that transition go a lot better because you're being engaging. You want to be inclusive with this company because you're essentially onboarding all those employees once
hmm.
you do the acquisition and you're making them part of your organization. If they can have a better certainty about what that's going to look like and what more about the company they're going to be joining, the better off the transition is going to go.
Well, we didn't do that. I mean, like, and I know a lot of people.
It's not like a common
No, I
practice, but
know. It's so important. Now it's funny that you brought it up, man. I was like, the podcast we did 4 or 5 years ago, you brought that up too. And I was like, yeah, like, I think those are the couple times that people have talked about it. I'm a huge proponent of that for sure with private equity, because it's like, if you're rolling equity, like you're technically an investor in there. So you have every right to be doing reverse due diligence. But like, it's so interesting, man. Like I think about the operational synergies or like the actual like financial models become so mechanical, which yeah, there's pros and cons and a lot of tension and arguments that can happen around that stuff. But I keep going back to the go to market strategy and the culture. And if someone's never been through a deal or bought a company or sold a company, like and I struggle with this, Kisan, because there's so many people are out, how many culture consultants are out there, right? And they're like, hey, we can assess your culture. But like, it really boils down to the nuances of like, hey, I believe that we should go to market like this. And like having that conversation. So unless you've been screwed over, you don't really necessarily know to have that conversation. So how do you take someone to enlighten them about how to assess culture and have these conversations? I mean, like, is there or is it just through time or like what do you see that works?
I think there's a lot of interactions that you just put a holistic view on. Um, it's tough because everybody's got different views on this, right? If you talk to the HR folks, they've got a very strong opinion about culture. But when you look at honestly at the very few people that are involved with making that deal, because once that LOI is signed, I mean, it's just game time. Like we're not culture isn't going to get in the way. We're going to get to close. We're not going to stop this deal because we don't think it's a good culture fit. Um, rarely,
Right,
rarely.
right,
You
right.
may have some blank red reasons why, but not really. So that's where I think the emphasis is doing it upfront early. And it is. I've done enough of these interviews when we were running through diligence on a deal recently. And it was a little awkward because I'm just like, I got to do this stuff because I've learned about it. So I can't just ignore it. But it is. It's a little funny to have these specific questions to really understand what that company's culture. And it gets to that, right? You start on the values. You get an understanding of these things that define their way of working. Then you get into the leadership styles. Then you get into the real decision making stuff.
Mm-hmm. Mm-hmm.
And then you can identify in this instance, you could tell like we operate at a much faster pace than this organization that we're looking to combine with. And it's like, this isn't going to go well. Like it's just going to annoy them and annoy us. Like it's
Mm-hmm.
not going to be a thing. So I don't know, and that's a small deal. I don't on this bigger ones too. A lot of times you got a lot more stakeholders and bigger numbers, and if you got a business case and how this is going to generate a significant amount of value, then you tend to minimize those things. So that's the thing to be mindful of, realistic about. As much as we like to emphasize culture is the biggest thing. There's philosophies. I've talked to some of the most seasoned M&A people with over 100 closed deals under their belt, and like you said, at the end of the day, there's going to be a new culture.
Mm-hmm.
Each culture is unique between these companies. When they combine, it's going to be different, anyways.
Mm-hmm.
So we're not going to, we'll put some considerations around it, but it's never going to be the primary driver of whether we do the deal or not.
It's so fascinating, man. And I'm curious on like in your size of the marketplace, like how many people that are acquiring or like, because corporate development divisions, that's their job is to go find companies and find the proprietary deals, do the deal like you're talking about. How many of those individuals have a long-term bonus plan tied to making the acquisition successful?
It depends, right? Because you don't want to make it too directly tied to doing acquisitions, and people are objectively trying to acquire revenues,
Mm-hmm.
right? Because then
Mm-hmm.
you're setting yourself up for a lot of bad deals to happen. So there's got to be some defined bonus around the real value that's created. Now, corporate development's job isn't necessarily to do this whole M&A, find the deals, and so forth. Their job there is to support the deal activity, and ideally, it should be a business unit leader that has a clear strategy and is actively identifying those opportunities and working with corporate development to execute on them.
That is super enlightening. Because like what you're just saying is like, hey, if they have a division of a product or service, that product or service has a partial acquisition strategy tied to that division's growth. They're going to use the corporate division of the skilled professionals to accomplish that. Was that what you're saying?
Yeah, because that ownership is there, right? So
Right.
you're going to buy a company, right? You're going to be 100% part of it all the way.
Mm-hmm.
And you know about how much distraction it's going to be
Yep.
because you're going all in. You know, you got a lot you're investing and you're really going to be heavily involved with it. And then when you look at a larger corporation, it's comprised of a bunch of different businesses, and there's a bunch of different business leaders that own those different business lines. So you want that. You want one of those business unit leaders to own that acquisition because they're the ones that ultimately got to take full accountability of the P&L once
Mhm.
things are said and done. The corporate development person doesn't do that.
So, yeah, it's
They're
the
going to be on to the
next
next one or
deal.
helping the next person.
Right, and not sitting there handholding, making sure everything that was talked about was actually getting followed through with. Yeah, you
They help a lot.
mhm.
They definitely can help really define the strategy for M&A. They can help even search and look for some of the opportunities. But that real champion's got to come from that business line that's ultimately going to own it.
So, let's talk about, how like, in when if someone brings the integration plan to the forefront during due diligence, do you have any of your clients that are actively then looking at that integration plan and looking at add backs that are the investments? And here's why I'm asking this, Kison, is that I got quite a few people that I know that I've got introduced to them after they did a roll up strategy, and they're managing their financials by the net income, not the normalized EBITDA. So they're not doing integration. I think about how ridiculous that is, man. Because it's like, well, our net income will be lower if we're integrating. So like, like is when you're looking at it from like the size, I think it's just more of maybe the maturity. And I don't want to project, but I'm curious in how you see it. But like, if someone's going in there and they're looking at the projections, I mean, do they have like an integration budget that is an add back for themselves as well? How do they track? How do they treat that?
Almost, I've seen this comment. Usually, the first two couple deals, the first maybe three deals, that say you don't properly plan budget your you don't properly budget your integration. You missed the mark on it. Even that first deal, you don't plan on any budget for integrating the company, and then you run into some surprises there because you should. If you want to capture these points of value, you should budget for how you're going to integrate. It's expensive. It's not. There's a lot of people you need. If you use external people, those resources, you're going to expend have some expenditures related to integrating the company. So that happens often.
Yeah.
I forgot the other part.
No, no, it's just so like it's almost like where that you could ask that one question if you're the seller, like budgeted for the integration? How are you going to handle it? And if they just look at you with a blank stare, you're like, got it. Well, it's because again, then all the hopes and dreams are not going to be realized if all of a sudden everybody's trying to reduce expenses versus do the investment of the integration. I mean, it's just a expense versus an investment mindset that you could spot right off the bat.
I agree. I heard it's something around 3 to 5%.
That's interesting.
Typically ends up
Okay.
you should have put to the side for integration related expenses and activity. This is all little odds and ends stuff, right? Maybe you get a bunch of new swag put together to introduce the new employees to the new brand and get them excited about it. And that's stuff like that. The events you do around it,
Hmm.
all these system migrations and things like that. But yeah, there's definitely
How
a
like
lot
the
of
people that are
activity.
doing like active acquisition strategies, what the people, I don't know if that's one of your typical clients, but like what's like a what are you seeing as like if someone has an acquisition strategy that's part of their organic growth, like how many deals do you think that someone could successfully acquire and integrate over what period of time? I'm just kind of curious because I think about the PE stories that we all hear or that I've been exposed to versus like someone that's buying one or two a year. And like, I'm just kind of curious, like what's practical, do you think?
Yeah, well, so we bucket in three, right? You have an occasional acquirer that does 0 to 1 deals a year. You have a frequent acquirer that does 2 to 10 deals a year. Then you have a serial acquirer doing 10 or more deals a year.
Yeah.
Now, these serial acquirers, they have an army, and you see them with like 30 to over 100 plus people dedicated to M&A in that organization. And their integration will have dedicated team for integration, and each functional department will have dedicated folks for integration.
Mm,
So they are able to allocate resources to run a number of concurrent acquisitions at a time.
yeah.
So it is different. I think there is how efficient can you do that? Yeah, the bigger deals,
Depends.
it's
Hmm.
harder. They're dealing with bigger challenges. Those large deals can be a multi-year integration exercise.
No, that was super helpful, man. Like how you bucketed those down. Cause again, these are just, I'm trying to highlight the simple questions that are just like, that are such a leading indicator. Like, hey, how many do you do? How do you budget? What are your resources? What is your plan that is tied to the future growth? And based on their responses, I think you could probably look on their face on like how serious they are about doing this.
I think leadership is like the key to all of this. The biggest challenges I see are with organizations. They're new to M&A, and they're doing it, and they're learning the expensive way, I guess. Can you bring in an experienced person? However, you can find somebody that's experienced can help save a lot of headaches and costs. I think that's the
Mm,
big thing I've seen. Because when
mhm,
you work at some of these mature companies, really, really do a good job in acquisitions. I hire some of the tech companies I've seen where they've just got such a good culture. A lot of that agile thinking is already there from their engineering culture,
mm,
and they have seasoned leaders that have done it before, and they know how to support an incoming company, really drive that leadership, align with their leaders, have the right messaging. They don't leave a bunch of unanswered questions, and for people to be very concerned about their future employment
mhm,
and those things. Or even if they are cutting people out, they are very clear and they communicate it in a way and saying, "Yeah, we are going to eliminate your role, but we're going to need your help.
mhm,
We're going to need you for 6 months. We're going to set up a package so that we're incentivizing you to be here. We're going to give you a great severance package and help you transition. Whether it's a role in our company or outside our company, we got your back either way."
mhm.
When you communicate that way, it just sets things up to be a much better integration.
Yeah, leadership, man. I think you're spot on because like every time we bring on a new client or someone that's coming through our training that's telling me about where they want to go and what's stopping them, so many times it's just like, hi. It's like here's the mirror, and it's just like and what I think I've seen from my side of the market, Kizan, is that like the last 3 or 4 years, the amount of activity and how the cheap money and the stuff that's been flowing around. I don't. It'd be interesting to find the data point. I don't know if it's out there, but how many were new people involved in this space? And it's like, cause like every time I talk to someone and they're like looking at an out of the blue offer, and I'm just like, you've never done this before. And I'm just like trying to think of like, I immediately think of all the things that I would be asking. I'm like, oh, they don't know any of these questions. And it's just like, but it's like this gap,
Yeah.
it's this gap between expectations and reality. And the good leaders know that that's where all the shitstorm happens. So like we want to thread expectations and reality together as fast as possible. But if you've never experienced it, it's all just conjecture and you're just kind of like hoping it all works. So I don't know if you like how many people are new that have been involved over the last 3 or 4 years. I mean, have you seen?
We tend to work with frequent acquirers, so they're typically doing two or more deals a year. Um, but I can see that as the biggest challenge is that lack of experience. I think starting off with the small deal is probably your best bet because you're going to go through it regardless. It's just like anything, entering a new space. There's a big learning curve. You don't have that domain expertise to leverage. Same thing goes with M&A. So don't take a big bet the first time around. Build into it.
That's some solid advice, my friend.
I think that's fundamental best
Yeah,
you can do.
don't.
Because we could sit there and talk all day about, get this, do all these things we just talked about, but you're probably not going to do any of it. So just try to minimize your loss by don't doing a big deal right off the bat. Do
Oh,
something really small. You get, take the loss because you'll have some. You're probably not going to make out the best in that first deal, and then it's coming.
yeah, right.
You'll figure out quickly and
Well, it's
build through
interesting, man. Like
repetition.
yeah, no, amen, amen to that. Based on the deals that I've been a part of, it was like, oh, they tried to bite off an entire elephant right now, and they don't know how to chew their food. So, but what I find interesting, maybe you can speak to the strategic acquirers. I don't know if you've got any comments on this, where the strategic acquirers and the size of deals, well, maybe not strategic acquirers, just any buyer's desire for the size of the deal to make it worth it. Because a lot of, the middle market entrepreneurs that listen in, it's like, hey, whether they got a $10 million company or $100 million company, those are big companies, but all of a sudden they're sitting down next to someone that might be doing a half a billion or a billion, and they're having this conversation. But someone recently, I was at a conference, and like, yeah, they said no because it wasn't worth it to them. And they just were flabbergasted. So do you have any comments? I could see you nodding. So
I think it's your own judgment, right? You as a executive, your job fundamentally, CEO, is to manage capital, right? Fundamentally, it's capital allocation. So if you're looking at doing a deal, even for us, we're still a growth company. We have two of the three business lines are over 100% year over year growth. So we're like looking at some of these opportunities thinking, is this going to be distracting, taking away from strong organic growth that we're currently having?
Mm, mhm.
So there's those type of things where you're looking at the whole picture. And that's where,
That's where the
hey, this might
numbers
not
matter,
be.
like the ratio of the size of the
And
deal and the accretiveness of it, yeah.
yeah, and then looking at the whole thing because it does because there is that challenge you have on resources where you can say that a small M&A deal is just as much work as a bigger M&A deal.
Mhm,
Fundamentally the same.
mhm.
That's why I say go do the small
Well,
deals so
that's
at
what I
least
was
you're
saying,
not
that's why I brought yeah,
betting the house.
right.
But you'll see quickly, like doing the effort on a small deal versus mid-size versus large deal is fundamentally very similar. You got to go through a lot of the same exercises to do it. You get some scale as you do bigger deals, but it's still hard. So I think that's why,
Mhm,
because when you look at what kind of economic impact you're going to make
mhm.
and have to go through all that, yeah, you could call a deal too small.
Well, it's super helpful, and the reason I thought about it is because if you're buying a company for 5 million versus you're buying a company for 50 million, that like we teach in our academy and principle 4 about growing value. There these functional areas of a business. It's like regardless of the company, the industry, you have HR, you have operations, you have leadership, you have IT. Like even if you have a lemonade stand, so like you have to all that has got to get integrated, regardless if it's $1 million or $100 million. So like you said, I think it was
I said, and you're distracting everybody,
yeah,
right?
right,
If you got to pull all the functions, you got to integrate them. You're literally giving extra homework for everybody in your
right.
company. And if they don't see and understand the value of it or are excited about it, that's not a good thing. You're causing more friction.
Yeah, distraction, same quotas, same everything, but just more work, right? Yeah, that'll go over well. Um,
If anxiety, maybe they're a small little company, they're pre-revenue, but they have this capability that's really unique that will get your sales team super excited to sell their product.
mhm,
Okay, great, it's worth it.
mhm.
But yeah, if you don't have that and they're scratching their heads around it, probably not better to do that deal.
Well, like I said, well said. So as we're getting close to the wrap up here, man, I'm just so curious. I mean, you going from the corporate world and M&A, probably making some good money, to jumping into entrepreneurship where you eat glass and stare into the abyss, according to some Steve Jobs and some people. What did you hope to make? What did you hope to do with your businesses, and what do you hope to do to make it all worth it? Like, what's the passion and the fire in you, man, to be doing this?
I'll tell you straight up. When I first started this, I thought I was going to just make some quick money. I thought in 6 months I'll be sitting on the beach, just refreshing my bank account, watching that
Yes.
number go up. And then it was a painful wake up call. 7 years of negative tax returns to realize it doesn't happen that way. I think after enduring that pain, I tell these undergrad kids, learn to suffer. That's the way you want to be successful. Thing my dad used to always tell me when we were little kids in the back seat complaining about stuff. You learn to suffer.
It'll do you
And
good.
now I understand. Now I understand what he means. For us, it's about the industry and the impact we want to make in the industry. We look at M&A as highly inefficient industry and just the connotation that you get when you talk to people about M&A. They look at it as a very negative thing. They associate it with layoffs, they associate it with chaos and some of their favorite products getting destroyed and things like that. And I think there's a way to rethink M&A and as something of what it actually is. It is a way to create an immense amount of value, and it's a way that it's always stemmed off of a vision for innovation. When you look at the drivers of doing M&A deals, it's just the current way of doing things often misses those results. I think
Mhm.
there's an opportunity to rethink the way M&A is done so that it is more fruitful for everybody involved, that it creates more opportunity, creates more growth, increases GDP, and can help organizations create value.
That is a noble goal, my friend. I love it. I love it so much. What would you do if someone offered you a huge chunk of money to buy your company just to take the clients to do more deals and not fulfill that legacy?
That's tough. I mean, we get some interesting offers, but I know we can, I just don't know what to do. Like for me, it's like, okay, with that money, buy a nice house and car, but then what? That's not,
You already got
you're
your
back.
new house under contract anyway, so you're already halfway there.
Yeah, I had the buyout firm ask me the same question. I turn around and ask him, "What would you do with that money?" He's like, "Buy a company like yours." I'm like, "All right, I'm a step ahead." So,
I love it. I love it, man. I love
what's
yeah, no, seriously. I was interviewing Sonny Vanderbeck. I don't know if you're familiar with him. He's a private equity guy. And he's like, I was sitting next to my buddy who was explaining to me this awesome company that they got. They got new management in place. They're kicking off cash flow. They got great growth projections and they got an offer. They're going to sell it. Sonny goes, what are you going to do with the money? He's like, find a great company with good management and great. It's just so funny, isn't it? Oh, it's awesome.
yeah, so I'm not bored yet.
uh,
I think we're at a fun stage. We're about 46 people in the company right
that's
now,
awesome,
so
man.
it's
Congratulations, dude. I love it because, like, when we were both talking years ago, it was both like, all right, man, we're both on this roll. Let's figure it out. I think I was even trying to figure out if we could plug in deal room to some of the stuff that we were doing, but it's fun to watch that people care. And I think it is a sign that you're growing, that the M&A market is maturing of like, hey, this has got to be worth it over time. I mean, so I think it's good. I think you're making an impact, man. It's awesome.
it's funny when my kids, like 7 and 9 years old, 12-year-old daughter, they keep up with M&A news. They follow what Elon Musk is doing with Twitter and stuff. It's interesting. It's changing. Like M&A is really becoming more mainstream.
So
So
it is, man. It truly is. It's like, oh, I was giving someone else the analogy. It's kind of like what real estate happened with real estate investing like 25, 30 years ago. I don't know if it's maybe part of that.
yeah,
And it's a good thing. I mean, I think a lot of younger people have to get into it to, get some of these baby boomers that want to transition out. They got to get involved somehow. So I got two final questions for you, man, because I know we're running up to the timeline here. First question is the word intentional. I love asking what it means because it's the name of the show, and I've learned a lot from people's responses. So I'm curious in what the word intentional means for you.
I tie it to discipline.
Mm,
When you have intent, you want to stick on track with it and not deviate. So I always think of discipline. That's one of my core values. Just
I love it.
committing to things, whether you're uncomfortable, comfortable,
Be comfortable with the
staying on
suffering,
track.
Kison, like your dad said.
Yeah. Learn to learn to
Learn
suffer.
to suffer. Learn to
Yeah.
have that discipline to suffer towards your goals. No, I think
The
it's great. It's great, man. Where can people find you? M&A Science, the podcast, the deal room, everything.
mascience.com. I think it's all on there. You can probably find a way to get a hold of me on there too.
Yeah, I love it, man.
Podcast, same thing, M&A Science.
Thank you so much for coming back on the show. It's been great catching up, man.
I'm glad we had time to collaborate on this, Ryan, and we'll look forward to the next conversation.